Why are mid-caps off the radar screen for so many investors?
Mid-caps are not only ignored, but I'd call them the Rodney Dangerfield of the asset allocation model, which is they get absolutely no respect, and that's a shame. Because they can give you as much or more of that growth and innovation that so many investors look for, even outside the United States, going to emerging markets, et cetera, while they can do so right here and with a lot less risk than they get going outside the U.S.
Okay, so three guys who represent a sector that's not as loved as it should be. Tell us why. Tell us why you should be loved. What's going on in mid-cap today that makes it such a valuable area to be involved in?
Yeah. And I would say I think the importance of those balance sheets really rang true over the last 5-7 years, where so many of those small cap names that couldn't get financing, couldn't get their receivables lines, refinanced, didn't make it out of the credit crisis, and so many of those mid-cap companies came through shining bright.
Brian, any thoughts on that and the movement? I mean, does it change what you follow every year?
No, the beauty of the space is that every morning you wake up, you have over 2,000 of them to choose from. And so many of them, as it was mentioned before, don't really get a lot of attention. And so being a core manager that's looking at everything from traditionally defined growth to traditionally defined value, I'm agnostic to whether or not that company is necessarily going to be the next Home Depot. I'd love to find a handful of those while I'm at it, but there are always great value opportunities in this space as well. So I'm looking for them all.
So let's go into that a little bit more. Everybody has your own sort of unique approach to doing mid-caps. Again, Brian, go into yours. How do you look at mid-cap stocks?
Yeah, we look at the space, and the way we manage our portfolios, the mid-cap core portfolio, is that it can be more or less a one-stop shop for someone who either already loves the mid-cap space and wants to do it with one product, or, and as so often is the case, does not have an allocation to mid-cap at all. And so we can do that with one product. And so we at ClearBridge Investments in our space, we're cash flow investors, we're balance sheet investors, we are capital discipline investors. And so as you're looking for those characteristics in mid-cap companies, you can find them whether they be traditionally defined value or traditionally defined growth.
So without, I guess we can't go into specific stocks, but what in general is unloved these days, where there are opportunities? What in any kind of sector or any area in the mid-cap world, what do you think are particularly good values now? Well, Brian will go for you.
The beauty of the space is that usually you can find unloved or grossly mispriced assets in nearly every sector.
So sad. I mean, nobody.
I know. It's like I said, the Rodney Dangerfield of the asset allocation model.
So tell us where there's no love.
Where we're not finding opportunities, we're having a hard time finding mispriced stocks and utilities. We're having a hard time finding mispriced stocks throughout most of consumer staples, big chunks of the financials sector. But in contrast to that, I would say that we're finding great opportunities, especially after this most recent rollover in the market within tech, within especially the software subsectors of information technology, within industrials. I would throw that in that group, and even consumer discretionary.
Do the mid-cap companies have balance sheets that are strong with the large caps in terms of sitting on as much cash, for example? The large caps seem to have so much excess capital around, and they don't seem to find anything to do with it. Is it the same problem in the mid-cap, or a problem with the same condition in the mid-cap world?
I would say that you can find very, very healthy balance sheets of these companies. In some of the later stage, if you will, or more mature mid-caps, maybe they do have that issue a little bit. For the most part, though, you're talking about companies, in the earlier stages of their evolution. And so more often than not, they're worried about using that excess capital to reinvest in their business and to continue to grow it. So while you do see some merger and acquisition activity in the space, typically the mid-cap companies are the ones that are being acquired and not the ones with those big lumbering balance sheets where the management teams don't know what to do with their cash, and so they make acquisitions.
Let me go back to some points you mentioned earlier, though, Brian and Steve, about M&A, and this is mid-cap stocks being traditional targets for acquisition, and there was some thought, I guess last year, the year before, that there'd be more M&A going on. The conditions are ripe, low interest rates. We haven't seen so much of that. Why not, and why do you think it might pick up in 2014 and 15?
Yeah, I would say I'm sympathetic to what those management teams were going through. We all had powder burns coming out of the credit crisis, and so if you put yourself in the shoes of that CEO or the board, and the economy is beginning to pick up, but it was just a couple of years ago we thought the world was coming to an end. That CEO might think twice about taking on additional risk, the risk that's associated with making a big acquisition. So now what you have is a balance sheet that continually gets stronger because the companies have now grown with the economy. Maybe their demand has picked up for them, so that balance sheet is even stronger. As was just mentioned, that company has probably already increased its dividend a couple times over the last few years, has already bought back a bunch of stock, but now their stock price is 100 or 200% higher. So buying back those shares gives you less of a return. And what are your only alternatives? Leaving it on your balance sheet, which earns you almost exactly zero, or you could pay down debt, but you've just refinanced all your debt at historically low levels. So what do you do with it? That M&A really should be here. I would have expected a little bit more the last couple years, but I think what you're seeing now, and there are surveys of this, CEO confidence is rising, board confidence is rising. So all the ingredients are right for a pretty big increase in M&A. And I would say if there's one thing that's different today than was the case, say, a year ago, it's that it's not only the share prices of the acquired companies that are rising, but more recently the share prices of the acquiring companies have also rose. In 2013, while the overall market was up about 30%, the share prices of companies that were acquired during that year ended the year up on average over 60%. I think it was like 64%. The average return of the companies making the acquisitions also exceeded the market and was up 48%. There's a couple companies in our portfolio that were, and this doesn't happen all the time, but we're on the buying side of this, and the share prices were rewarded because the deals made great strategic sense, and it put to work a balance sheet that up until that time was less than optimally utilized. So I think I would be shocked. I don't know if you guys agree, but I'd be shocked if at the end of 2014 we didn't see some acceleration in merger and acquisition activity.
What about corporate activists? How do you view them in the companies that you follow when they get involved?
Sometimes they have our interests in mind, and sometimes they don't have our interests in mind. So it's understandable when an activist picks on a company that may be undervalued, significantly undervalued. Maybe they had utilized their capital structure inefficiently. And so certain companies might be more ripe for activist activity. But if the activist just comes in and says, hey, I think we should just lever you up and buy back stock, well, that may not be the best thing for that business long term. In fact, maybe just a good kick in the butt to kind of motivate management, and maybe reinvesting in that business may get you higher returns longer term. So just because we own a company and an activist gets involved, it doesn't necessarily mean I'm happy. I need to understand sort of what their interests are, and do they align with mine.
All right, let me play devil's advocate. This is such a great area that's so underappreciated. So somebody may say, an investor, well, why don't I just buy the index, an S&P 400 index fund? It's a great sector. It'll ride the sector. You're all right. You're the active managers, and you're shaking your heads. No. Tell me why that doesn't work.
Absolutely not.
Okay.
It's the worst of all places to ETF. I'll be honest with you. It's really, if there's a lowest common denominator that's come through here in the last half an hour, it's that this is such an inefficient segment of the market that an activist or two may come in. I'm surprised more aren't in there every day. There are fewer people paying attention to these companies, and therefore you have the opportunity as an investor to create an information advantage, not an illegal one, but to find companies that are grossly mispriced, that there are aspects of the business model or their future growth potential that are not fully appreciated by the market. And so, like I said, every morning you wake up, your challenge is to find these grossly mispriced stocks, and it makes it pretty easy to get up in the morning. But I'll throw out a couple of statistics that may prove my point. Within the Russell growth benchmarks, the 2,000, the 1,000, the 3,000, in many cases you see upwards of 25 to 30% of the companies of those benchmarks are unprofitable. Okay, so just give you that scenario. Within a Russell 3000 type of environment, if you buy the benchmark, just understand that at least a quarter of those companies did not turn a profit. Now, I'm not going to argue that you should never buy a company that's not profitable. In 2014, maybe there was some great growth opportunity in front of them, and there was a good reason for them to be unprofitable in 2014. But just understand that there's a whole bunch of companies in that benchmark that are unprofitable for a reason and may not be profitable maybe ever again. So if you buy the benchmark, understand you're owning a small piece of that company. That's not necessarily a good thing. And the other thing I would point out is that within the Russell, you're also buying at upwards of 20 to 25% of companies that are trading over 30 times earnings. Not that, maybe buying some of those companies that are trading over 30 times earnings is a bad idea. If they were, just entering a 10-year growth phase where they grew 30% a year, that may be a bargain. But again, understand that if you add those two up and you buy the benchmark, you could be buying over 50% of companies that either aren't profitable or are questionably valued. And so instead of doing that, why not trust someone who is spending every waking hour of the day looking for grossly mispriced companies that are attractively valued and that do have great earnings growth and cash flow potential? So you can see I'm kind of passionate about this when you ask me about whether you should buy an ETF in mid-caps, but I would strongly suggest that you don't.
Let's follow up on the attractiveness aspect without going into specific stocks, which I know you can't, but let's talk about sectors or areas within mid-cap. You said REITs, maybe less so. I don't know. But let's go into the areas and see what you find attractive now in general and what's less attractive. So, Brian.
Let's go back to IT. Let's go back to tech. I'll tell you that I'm seeing some wonderful growth and really game-changing innovation within, for instance, enterprise security software.
What is that exactly? Not fire alarms. So what is that?
The software that keeps the bad guys out of your network.
Okay.
This was all brought to light quite dramatically recently when Target was found to have had 30 or 40 million cards infringed upon. So that was the sort of eye-opener for the general public. But if you speak to the companies, as the three of us do, and you ask CEOs and CTOs what really keeps them up at night, it's the guys in the Ukraine and Russia and the guys who are getting paid to get into our networks. And so when you think about the innovation that's going on here and how critical it is, I think there's some wonderful opportunities there. What you're seeing within biotechnology and genotherapies and immunotherapies, where those two collide, we're not just extending the lives of cancer patients by 6 months. We're flat out curing people in some cases. So you see some great opportunities within, generally healthcare there. Within oil and gas, I know sometimes the fracking industry is getting darts thrown at them, but the reality is, and it's an inconvenient truth for some people here, that we've added 2 to 3.
That was a nice way you put it.
Yeah, right. But we've added 2 to 3 million barrels of domestic production here, which has backed out almost 100% of the oil that we had imported before then from all countries except Canada and maybe a little Mexico. So almost all of our Middle Eastern importation, almost all of our Venezuelan and South American importation. So when you think about real game-changing stuff, this is, I mean, and these are mid-cap companies. Go out to the Permian Basin in Texas or go up to North Dakota, Montana, South Dakota, look around. Where's Exxon? Where's Chevron? They're nowhere to be found. It's the, and I'm not giving,
but names people wouldn't really know necessarily.
They're all the mid-cap companies that are doing this, right? Where were those big lumbering networking companies within tech that make routers, historically have made routers and hubs? Well, they kind of fell down on the security piece. And which are those companies that are bringing all that innovation and keeping the bad guys out of our networks? They're the mid-cap companies. And, you know, they were small cap not that long ago. So I bring up those three subsectors of the market where you would have thought the big caps with their great big R&D budgets would be dominating, but they're not. It's the smaller, more nimble guys that are doing the work.
Let me turn things around a little bit and just ask about what the sell discipline is, because obviously buying smart is one thing, but selling smart is another important characteristic. So how do you determine a sell discipline? What is your sell discipline?
To review when we're wrong. You know, we don't like to be wrong, but occasionally it happens. So we will sell a stock immediately if our investment thesis is not playing out. You must have that discipline. When we're right, alternatively, when a stock reaches your fair value, you have to have that discipline of not falling in love with the stock simply because that investment thesis has played out, but yet, okay, this stock is fairly valued, let's sell it. And if you believe me when I say that there are always great mid-cap stocks to reinvest in, then you ought to have the discipline to sell that stock and reinvest in another one that gives you a higher return. And then, as you said, a company could be taken out, that's sure. But also, at ClearBridge, we are very, our style purity and market cap purity is very important to us. So if we are right, for instance, and that share, that company has risen all the way through $15, $20 billion, the upper end of the range of the mid-cap benchmark, as difficult as it is sometimes, you have to have that discipline to sell the stock, reload, and go back and find the next, you know, potential Home Depot.
Can you pass along to a large cap manager? And
well, we do, and I happen to think we have some of the best large cap managers on planet Earth. So, but by that time, we've made them aware that that company is coming, and they should, you know, we'll tell them all about it. But you have to have that discipline. So many of our clients look at the world through a very, very rigid asset allocation model. And so if we were to just let all of our investments rise all the way through large cap, we'd be screwing up their asset allocation models and doubling down on their large cap holdings. So we don't want to do that.
Well, we're reaching the top of the hour, so let's get a takeaway for everyone watching to recap and put a sort of a highlight on the mid-cap space. So, Brian, let's start with you. We'll work back.
Okay. If there's anything that's come out loud and clear, it's the opportunity to create great value, to find mispriced stocks here. And thankfully, that was the case 20 years ago. It's the case today, and I've seen absolutely no reason why that will not be the case for another 20 years. So by investing in this space, you get access to a great growth and innovation segment of the market, of the economy, and in doing so, you're getting a lot of these companies at just wildly great prices.
Terrific, gentlemen. Thank you very much, Steve, and Brian. For a sector that doesn't get much love, we've seen a good reason to love it. So thank you all, and thank you for joining us. This is Evan Cooper for AssetTV.